I blew 9 prop firms account before passing my first one. Every time I blew one, I was asking myself, am I the problem? Is this worth it? Does this even work? Did I just waste all this time studying, backtesting, and learning for the past year for nothing? Am I just gonna quit? And I was wondering, like, is this something worth pursuing? Can you actually win in it? And the answer is yes. And all you need to do is figure out your model, one model to follow, and I did figure out mine. So I trade one time frame, one model, one setup, and I trade only in Q. And in this video, I'll show you the exact model I'll trade, every detail of it, and exactly my step-by-step plan. And I have it all written here. So what is a liquidity sweep, right? I trade ICT, and basically a liquidity sweep is when you have price sweeping a liquidity, right? So this is a high and this is a low, right? So price, in order for price to move lower, in this case, let's go to the higher time frame and look at it. In order for price to move lower, what does it need to do? It needs to take out, it needs to grab liquidity. It needs to take out some high, right? Order, so break, like trap breakout traders into going long and put the stop loss of people going short, trigger the stop losses of people going short. So people that are already going short here, let's say, and then we're down here, they're gonna trail the stop loss, they're gonna put their stop here, right? They wanna like get trailing stop loss. So example, right? So in order for price to move lower, what we need to do is we need to sweep it. So for example, we should sweep this. I mean, we shouldn't because there's a fair value gap, but it's just an example. We should sweep a high to move lower. Always price before moving lower, it needs to move higher than lower, right? And vice versa. For price to move higher, it needs to move lower than higher. Yeah, pretty simple. So this is a liquidity sweep, and we can go into a bit more details because for me it was so difficult to understand this concept. I just couldn't understand it. I'm gonna put this. It was just, yeah, it was alien to me. I spent hours and hours, couldn't identify any liquidity sweep. So like it's more easy to spot them on the higher time frame. So what I do is I go on a higher time frame, right? Because always trade the higher time frame. Don't try to short the highs and just play it cool and, oh, market is moving higher, I'm trying to short it. You're gonna get like burned, completely burned. Don't do that. Follow the trend. The trend is your friend, right? Until it isn't. But, and then when it isn't, like, that's part of the game. You're gonna lose a little bit. It's okay. So like, for example, right? We have liquidity here. We go to the daily and we have obvious liquidity, which is here now. I think now we're probably gonna go lower, estimating lower prices as we inverse a fair value gap. Anyway, we're probably targeting this low right now. So like, let's go on a 4 hour and we're gonna see, where is liquidity? We have liquidity here, right? Here, here, and here. These are great targets. We have like equal lows here, like relative equal lows here. Great targets to look at, right? And then we go to the 15 minute, yeah, and we have like equal lows. So like, what are we seeing here, right? We probably have some sort of SMT, but we're gonna get into it in a second. So yeah, this is a liquidity sweep. Then, as you can see here, we have an SMT. And what is an SMT? It's basically a divergence between the two assets. So NQ and ES are correlated, right? And when you get an SMT, one asset, for example, sweeps a high and then move lower while the other asset does not. So there's a divergence between them. And that tells us that price has a more likelihood or chance to move towards that direction, right? It's always it's a game of statistics, and you can never be always 100% sure it's gonna go there. But then it's just, what do you have that back your trade idea before taking a trade, right? It's your confluences, and this SMT is a great confluence to have because it just proves that, or you have a higher chance that market will move towards that price. Let me show you what is an SMT. So an SMT is when you have a divergence. Let's say we're on both on the 15 minute, right? do we have an SMT here? Let's just, let's look at it. Okay, here we don't have an SMT. Do we have an SMT maybe? Yeah, we have an SMT right here. Literally. We have an SMT here and here. NQ, what I did, so it swept this high, all right? NQ swept this high, as you can see. There were stops here and buys, and market just swept it and then moved lower, right? So this happened, this, and then this. But then here on NQ, it did not. Market did not sweep this high, right? We're gonna say why? Because there's a divergence, because price is bearish and we're looking for lower prices. Yeah. So this is like an SMT. It's very simple concept, but very, very powerful to have and to understand. Like your eyes are not gonna see them automatically. It's gonna be difficult because you're gonna be like, oh yeah, but there's an SMT here, but not here. And it's like these small ones. No, like you need to train your eyes and your mind to spot these things, right? If you do archery, you're not gonna become a great archer the first day. This is a very extreme example, but like you're gonna become a great archer by going every day to the spot and training and learning, etc. Your eyes need to be trained to, like, you just know in your subconscious. So just give yourself the reps and give yourself the time and the patience to do it. But this is an SMT. So now we have two confluences. We have a sweep of liquidity, swept a high, and we have an SMT. Very good, but we're not there yet. We just don't press sell directly. Wait. The third confluence is a fair value gap, right? So a fair value gap is when price moves fast and aggressive into one direction. It leaves a gap. So it leaves a gap of orders that didn't get filled, or there is no orders that got filled there. So there is a gap, and price have a more likelihood of going back to that gap, fill it, and continue towards that direction if we are following a directional pattern, right? So for example, here, what we can see is we can see that price swept liquidity, we have an SMT, and then we have a fair value gap here. All right, this is a fair value gap right here. This is a fair value gap. And what can we see? We have our confluence, which is a liquidity sweep, SMT, fair value gap. This is a great entry. Like if you want a simple model, this is a great entry. Boom, you target like 1.5. You put your stop above, you can put it here if you want to be extra safe. You target 1.5R. At least that's what I do. I target 1.5R. Very easy trade. How many? Like very, very simple, easy trade. Fair value gap, boom, straight to the floor, right? And at the open, what's gonna happen is I'm gonna wait for this exact model that I just showed you, that just gonna repeat itself. Literally, just repeating itself over and over and over again. So like this is a fair value gap. It's a very simple concept. Price moved very fast and there's no orders to fill it here. And now price wants to go back, fill in some of those orders, smart money, and then go lower. Fair value gap has two sides of it. You have a fair value gap and an inversion fair value gap, right? EFVG. So an EFVG is when price go back to that fair value gap and then breaks straight through it, right? It's like breaking through it. And usually this is a very fun concept. It's basically made to fake out traders that are trying to trade against the trend. That's why I'm telling you, don't trade against the trend, at least when you're a beginner. What do you want to do? For example, let me find a good example. For example, this, right? This is a fair value gap, a bullish fair value gap, right? This is a bullish fair value gap, but then what are we seeing? We're obviously bearish, right? We're like going on a bearish direction. Some people will be like, oh, we swept this liquidity, now we have a fair value gap here, and let me go long here based on this fair value gap. What's gonna happen is it's gonna inverse it, right? And its characteristic is gonna change from being like tap in and moving to being used as another point of entry, right? If we can see here, we can see a reaction out of it. 1, 2, 3. See how it's being respected here, right? Okay, yeah, we went here because of time, as you can see. we were entering London, and then we broke lower, and the same thing happened here. Like it's being used as resistance, which I don't trade support and resistance, but this is what it says. Yeah, very simple, very straight to the point concept. Let's go to our final one, which I like, which really gives me a lot of confidence into taking, and it's a break of structure, right? So what is a break of structure? Is when we are structured, for example, we are bullish, right? We are bullish, and then we get something like this candle, right? This candle is very heavy. We have a fair value gap here, but what do? We are breaking all these lows and closing below it. This is like a break of structure that's pretty okay-ish, but this exact one, because literally this just breaks the whole trend, and this is a great entry. And if you can see, so this is like a riskier entry, and this is like amazing here. Like this is an amazing entry because we're breaking structure here, right? We're breaking structure, and then what do we have? We have a fair value gap here, right? We have a fair value gap. What are we doing? Tapping the fair value gap, first entry. Tapping the fair value gap, second entry. If you didn't enter here, this is a great entry as well. What is happening? Fair value gap, shits the floor. Tap say again, shits the floor. Bro, like very easy to spot. Very easy to spot. You just need to train your brain to follow this. All right. This is fractal. So this works on the high time frame, on the daily, on the weekly, on the 4 hour, on the hourly, on the 15 minute, on the 1 minute, however you want. It's fractal. It's the same logic, it's the same model, and it works on all time frame, which is crazy. So if you're a swing trader, if you want to hold for weeks, this works. If you are a day trader, this works. If you're a scalper, this works. This works for almost every model, but then you always need to tweak it a little bit based on you. But then when you're starting, you can just follow, copy, paste, man. Like don't try to be a genius trying to recreate the wheel. Just copy what's working, all right? And for the last point, so this is the step-by-step. Let me go through some examples real quick. So this is the first example. As you can see, we have SMT here, SMT here. This is at the open. There's time-based liquidity as well that we can talk about in another video. Yeah, very simple trade to take, targeting the lows, targeting 1.5 and the lows. And then I think after this price pumped a lot. Example number 2, longs, right? We have a bullish SMT here, here and here, right? On the higher time frame, as you can see here, bullish SMT. We are bullish, moving higher, pushing highs. What do? Break of structure. I entered a bit late, but this would have been a great entry. Break of structure, you enter long 1.5 hour, like 5 minutes into the trade, nothing. Very simple. I have other examples of my trades in my YouTube channel that you can view, and I'll be posting more trade recaps, more proof that this works, that you can just put in the time, put in the effort, and it will work out for you as well. Thank you for watching, and please subscribe. Thank you.